Okay, so in today's class, we are basically looking at the first two chapters. Okay, and chapter one is basically known as Introduction to Financial Reporting. So why are we looking at first two chapters? Because in the chapter two, it's not actually very long. So it will be covered there and then in this class, right? And these two chapters were basically the theoretical ones. So I asked you that we will have to do them at the end, right? So now here we are doing them. Okay, so first of all, we'll start chapter one. These are the theoretical things, so there I don't think there are very much exam kit questions regarding this, but still we have to cover the chapters. Okay, so chapter one, it is basically introduction to financial reporting. So what this chapter covers is, as you can see over here in the diagram as well, that there are a lot of things covered over here, like the statements, financial statements we've already looked at in, I think, the chapter after chapter 15 or 16, I think that is the one. And basically we'll be discussing the start of the things, and I'll be going through the financial statements as well, but the detail of financial statements we have already covered before. Okay, so first of all, let's see. This is basically just telling what is the purpose of accounting, right? So the accounting system of a business records and summarizes the financial performance or position of a business over or at a certain period of time. So this information is crucial to various stakeholders of the business, who will analyze that information to make significant economic decision. So obviously, the financial reporting, we have studied the whole syllabus right now, so you'll be able to understand this very well, that whatever we studied, it's all regarding the shareholder perspective, and shareholders look at all these information of the financial statements for summarizing and recording it, and they look at it and then make the decision of investing in the company, right? So there are very simple things, nothing difficult over here. This you can also read by yourself. This is basically the difference between financial accounting and management accounting. So since many of the students who are studying F3 have already done F2 exam, so F2 is basically management and F3 is financial. So naturally they get to know the difference of them in between them. Okay, now these are all the users of financial statements, right? This is also self-explanatory, there is nothing much to discuss over here. So obviously investor will need to understand the financial statements. Every investor is a user, because if we don't provide a report, let's say if we are manager in the company and we are conducting tasks from the operating level people. So if let's say we are launching a new product, so till then when we get no report, there is no use of launching that new product. We need to see what sales did change, actually advertising cost did change, how much percentage of sales change happened. So investors need to know what happens in the company, right? So these are the main users. Then customers are also users. Customers need to see that is it okay to buy from that business or not, so that the receivable and payable relationship is well maintained. Okay, then suppliers, then lenders, then government. Obviously government needs to know each and every government is a very important user of the financial statements, because it needs to regulate all the systems, and it needs information as well. Many government agencies nowadays in many countries, but we are specifically talking about the UK over here. The government of UK, it keeps a check and balance on all of the financial statements. That's why it is an important user. Okay, suppliers as well. Suppliers need to know which companies are paying in good time and which companies are paying their suppliers in bad time. And after that, we've got competitors, the public, employees, management. So all of these things, most of the students have already studied in F1 as well, right? So these are also the very simple things. You can read the detail as well. I am not going into much detail because the main topics over here, I am coming to that in just a little bit, right? So these are types of business entity, right? Types of business entity basically means that what kind of uh, there are business operating in the whole world. We've already looked at this in the start as well. So the first is sole trader. You can see sole trader is basically whenever one person is owning the business, and let's say he just keeps maximum one or two employees, but it's not like a full-sized company. It might be a small store or a small shop in which only one person is managing it, right? So this is the simplest form of business, where a business is owned and operated by only one individual, although they might employ any number of people, right? So basically it's called, naturally it's called small. Okay, with this form of entity, there is no legal distinction between the owner and the business. To this and the owner receives all the profits of the business. So obviously there is no need to divide the profits and divide everything. There is no need to wait for others to decide on the decisions, right? Because only there is one decision maker over here, that is the sole trader, right? Now there is one more word over here, that is unlimited liability and limited liability. Once I'm done with all of these business entities explanation, I'll explain you that as well. Okay, don't worry. The capital structure of a sole trader is also relatively simple. There is capital account, which represents financial interest of the owner. So capital account obviously is recording any kind of investment by the owner into the business. The capital account can be added to by the owner, introducing additional capital. We've already studied the capital equation, so you know all these things. Obviously, drawings are minused from this as well. Now, moving forwards, we have partnership, right? So similar to sole trader, the owners of a partnership receive all the profits and have unlimited liability. Don't worry, I'll explain both of these words, the limited and unlimited liability, for the losses and debts of the business. The key distinction is there that there are at least two owners. So partnership basically does not have one owner. It should be between, normally it should be between 2 and 20, right? Normally this happens in the whole world. So the capital structure of a partnership is similar to that of a sole trader. Each partner will have a financial interest in the business, and this will be divided between a capital account and a current account. So this topic is actually not in detail in F3, but if you look at the foundation subjects, the exam before this is called FA2, which was a foundation exam. So that paper basically has partnership as a whole topic over here. Okay, but don't worry, we are not focusing it very much. So similarly, drawings are also minus from here. Nothing special to discuss over here. After that, we've got limited liability companies, as you can see, right? So unlike sole traders and partnerships, limited liability companies are established as a separate legal entity to their owners. So this word I'll also explain once I explain the unlimited and limited liability, right? This is achieved through the process of incorporation. The owners of the company invest capital in the business in return for a shareholding that entitles them to share of residual asset of the business. So this is, like a proper company. Mostly limited liability companies are listed in the stock exchange as well. That's why they're called limited, right? So this is the reason why shareholders purchase the shares of these companies, and they are entitled to, when the company dissolves, when the company finishes, the shareholders are given part of the assets of the company. Okay, the shareholders are not personally liable for the debts of the company. So again, this basically has a limited liability, which I'll explain in just a while. Okay, so likewise, the company is not affected by the insolvency of individual shareholders. Limited liability companies are managed by a board of directors. So this thing we'll also discuss in just a while. That basically there are two peoples. The two people are basically the board of directors and the shareholders. So shareholders are basically the owners, and board of directors are the people who are appointed by the shareholders and controlling the company. Okay, the capital structure of a limited liability company is more formalized than that of a sole trader or partnership, and is illustrated within this chapter. Shareholders cannot make withdrawals or drawings from the business, obviously, because even if you look at this practically, if shareholders have invested some money, they cannot take it out. Yes, they can sell it to any other person, but they cannot take it out. Okay, and they receive a return on their investment, which is called basically dividend. This dividend we've also discussed in very much detail in the retained earnings chapter as well. Okay, so this is also just other knowledge. I don't think this is important. You can read it if you want, right? Now, coming back to the next topic, this is the main thing that I'm focusing over here, right? The framework, and this is the main basic spotlight, and this is the main highlight of this chapter 1. Okay, most of the questions will be asked from this. Now, what is actually the framework? Let's see. So one of the most important documents underpinning the preparation of financial statements is the conceptual framework for financial reporting, which is in short form called the framework, which was prepared by the Iasb. Right. So this, what is Iasb, we'll be looking at in chapter 2, which we'll have to do today as well. So framework presents the main ideas, concepts, and principles upon all the IFRS and IS are based, right? So all these accounting standards that we studied before, they are based on which standard the framework basically represents over here. Okay, now first of all, let's see the objective of financial reporting. The main objective is to provide financial information about the reporting entity to users of the financial statements that is useful in making decisions about providing resources to the entity as well as other financial decision. So that means this is the main objective of financial reporting, right? That we have to report the report all kind of figures that are important for the users who are making the decision to invest in the company. Okay, now let's see further. One second. Okay, so over here you can see there are few words like fair representation and all the other things. We'll be seeing this, right? So what is fair presentation? Let's look. In order to provide useful information to the stakeholder of the business, the financial statements must fairly present the position and performance of that business, which is basically called a true and fair view, right? So why this is important? Because so that all companies adhere and comply to the framework, right? To the accounting standards framework, which we are studying right now. And fair presentation, it's important so that there is no fraud element or a theft element or the company trying to scam customers. So there is nothing such as this. That's why fair presentation is important over here. Whilst this has never been formally defined, it embodies the concept that financial statements are compliant with relevant laws and regulations. So nothing wrong is being happening, right, in the financial statements, compliant with the relevant financial reporting framework, right? So if we are following IFRS, IAS, it should be actually the standards which are introduced by them, right? And they must be, correctly followed over there. There, there should be no loopholes in that. They have applied the qualitative characteristics of the framework as far as possible. So these characteristics we'll be studying in just a while. Okay, now these are the characteristics. From this you probably might be asked the MCQ, right? Examiner might ask you the MCQ from this, right? So first of all, we have qualitative characteristics, right? And after that, we have basically two things in this which we have to understand. Okay, now qualitative characteristics, from the word, as you can see from the word, it means that all kind of characteristics that the financial statements have, but they should be qualitative. So qualitative means that financial statement should have some kind of quality in them, right? So this is basically what it means. Now this framework splits qualitative characteristics into two things, right? So first is called fundamental ones and the second ones are called enhancing ones. Okay, again I'm repeating, there are qualitative characteristics which basically determine how much quality information is being given in the financial statements, right? And they are further divided into two parts, two subtopics, right? The first is fundamental qualitative characteristics. So fundamental means that these two things, these relevance and faithful representation, these need to be at the first priority, right? That's why they are called fundamental, because fundamental means anything kept on first priority on number one, right? And on number second, there is enhancing qualitative characteristics. So enhancing means that yes, these two need to be there, but to enhance this, just as a top up, these four should also be there. Okay, so I hope you understand the word. Now the first one is relevance, then faithful representation. These both are fundamental. We will be studying the detail of these in this one, in this box, right? It's a lot of detail of definitions over here, right? Then the enhancing ones are comparability, verifiability, timeliness, and understandability. So ideally we just need to understand them, right? We don't have to learn anything, but even if you don't read them from here, you should know that they are very simple. From the word we'll understand, right? From the, if we read the word, we'll clearly understand what this means. Okay, so firstly, talking about relevance, right? Let's talk about relevant. So information is relevant if it has the ability to influence economic decision of users, right? And it is provided in time to influence those decisions, right? So that means information should be relevant. It should be important. Like if I am saying in the financial statement, let's say I'm the accountant, I'm making the financial statements, and I'm just, let's say I have a pharmaceutical company, right? That the accounts that I'm making for, and let's say I start to in the disclosure notes, we have studied the disclosure notes, right, in which we indirectly talk to the shareholder. So let's say in the disclosure note we start to talk about car companies. I like cars, I like to produce cars. So will this be relevant? No, obviously this will not be relevant, because users of financial statements, the shareholders, all the users want relevant things, right? Relevant means to the point. They should be to the point, right? Now qualities of relevance, you can see. So information that is relevant has predictive or confirmatory value. This is just for reading. This has, I don't think, never came in the exam. Predictive value enables users to evaluate or assess past, present, or future events, right? So this is basically predictive. We are just predicting the future, right? And second one is confirmatory values, helps users to confirm or correct past evaluations and assessments. So this is called basically confirmatory value. right? So these are both qualities of relevance. Again, first is predictive value, in which users predict, like, if this is what's happening in the company right now, if the company starts to go with this space, what will happen in the future, right? If the company is going through this phase. And second is confirmatory value. So confirmatory is the things that actually have happened, right? So where choices have to be made between mutually exclusive options, the option selected should be the one that results in the relevance of the information being maximized. In other words, the one that would be of most use in taking economic decision. So obviously this is also explaining that we should choose that option which is uh, you know the best in taking decision. Okay. Now, further, there is one more small thing. Let's look at this as well. Threshold quality, right? So, one that needs to be studied before considering the other qualities of the information. A cutoff point. If any information does not pass the test of the threshold quality, it is not material and does not need to be considered further, right? So that means it's a cutoff point. We have to cut off the information. We don't have to go any further. So this basically further explains that it's basically called to the point, basically being to the point, right? So when we have written the point, we just have to cut it off, right? Nothing further we have to write, because if we write anything further, the information will just become irrelevant. Okay. Now, secondly, information is material if its omission or misstatement could influence the economic decisions of the users taken on the basis of financial statements. So, if information is material over here, this means that it should influence the user's decision making, right? Either to invest, either to not invest. Is the company good or not good? So, this influence is basically called materiality. We'll be covering that in future as well, right? Now, the second one, the first two, remember, they were the fundamental, right? The fundamental one. We have not come towards the enhancing right now, right? Now, second one is faithful representation, as you can see over here. Okay. If information is to represent faithfully the transactions and other events that it purports to represent, they must be accounted for and presented in accordance with their substance and economic reality, and not merely their legal form, right? So there are basically two or three things that we need to consider over here, right? So in faithful representation, again, remember the word tells us that we are faithfully representing the information. Nothing is of biased nature. Everything is unbiased. We are just reporting, even if the information is bad, even if the sales have gone down, even if the profit has gone down, we are just reporting as it is. This is called faithful representation, right? So first, it needs to be completeness. To be understandable, information must contain all necessary description. So it's not like this, like let's say profit was this time very low, right? But let's say sales were very high, right? But costs were very high as well. So we just write the correct forms, like we decrease the cost over here. We don't write it as increase, we decrease it, so that the shareholders see this as a good thing, right? We don't have to do this. And we increase the profit. No, we cannot do this. We just have to report the complete information. Either it's wrong, either it's right, either it's, not useful. We have to record it in completeness. Now, secondly, neutrality, right? So information must be neutral. That means free from bias. There should not be any bias. Financial statements are not neutral if by the selection or presentation of information they influence the making of a decision or a judgment in order to achieve a predetermined result or outcome, right? So we need to be neutral. We don't have to be very subjective that we have to increase the profit in every case. It's not like that. We have to be neutral. Okay. Now the third thing is over here is free from error. Information must be free from error within the bounds of materiality. Material error or an omission can cause the financial statements to be false or misleading, and thus unreliable and deficient in terms of their relevance, right? So also they should be free from error. There should not be any kind of mistake, any kind of error in this. Okay. Free from error does not mean perfectly accurate. Obviously, nothing is accurate, nothing is perfectly accurate in this whole world. There can be small kind of mistakes. For example, where an estimate has been used, the amount must be described clearly and accurately as being estimate. Okay, so these three things need to be in which quality? The faithful representation. Okay, right, now we are moving towards the second part, that was enhancing, right? So first one were basically the fundamental qualitative. Second ones over here are enhancing qualitative. Okay. So in enhancing, first of all, the word that we have over here is comparability. Okay. So users must be able to compare the financial statements of an entity over time to identify trends in its financial performance, right? So comparability means that everything is consistent over here, right? So again, it's written over here as well. For this to be the case, there must be consistency. Like if the company is adopting IAS 16, in the further years, it should also be adopting IAS 16 for all the non-current assets. And let's say if there are any kind of intangible assets, it should be adopting IAS 38 every year. It's not like this, like company adopted IAS 38 in 2020 year, but not in 2021. But yes, in 2022, it then adopted. So this should be consistent in every year. It should be same. Okay, this is very important for comparability, because if things are same in every year, then we should able to be compare, right? So compare the financial statements of different entities to evaluate their relative financial performance and financial position. This is also very important. Okay, so an important implication of comparability is that users are informed of the accounting policies employed in preparation of financial statements, any change in those policies and the effects of such changes, compliance with accounting standards, including the disclosure of the accounting policies used by the entity, right? So very simple things. Now, after that, we've got verifiability, right? This is the second thing, right? After basically after completeness, I think, right? Sorry, after comparability, this is the second thing, which is verifiability. So what does verifiability tell us? Verifiability basically means that we should be able to verify the information. It should not be wrong in any case. Okay, so verification can be direct or indirect. Direct verification means verifying an amount or other representation through direct observation, right? That is counting cash. Indirect verification means checking the inputs to a model, formula, or any other technique and recalculation the outputs using the same methodology. So this is basically called verifiability, right? It gave an example over here that we are checking the computer system cache. What is the accounting system showing us in the cash balance? We are checking that with actually counting cash, right? So this is verifiability. Now, third thing over here is timeliness. Timeliness means having information available to decision makers in time to be capable of influencing their decision, right? Let's say a share price went up, right? So basically, we should be able to give the information to the users of shareholders in a very timely basis. If we don't give it in a timely basis, then the shareholders will think that it's very late. The company has, no, basically no, you can say no warning about the time, right? It does not care about the time. So every information should be timely as well. Also, one more thing, if we are, let's say reporting to the manager, right? So manager needs to have everything timely. If we are reporting anything, that any incident that happened in 2020 year, we are reporting to the manager in actually 2022, that's 2 years later. So this information is highly not timely, right? Obviously it's not timely over here. Now, after that, understandability, right? So understandability depends on the way in which information is presented. So it should be presented in a very easy to understand words, right? And capabilities of users. So capability of users means that if is a user ACCA, is he, proficient in understanding accounting? If he is not proficient, we should be able to explain the things, right? So it is assumed that users have a reasonable knowledge of business and economic activities. Obviously, even if they are not fluent in accounting world, they should have little knowledge of business and, all of these things, supply chain, business, all of its operations, right? They are willing to study the information provided with a reasonable diligence. So diligence means with a reasonable focus, right? To basically involve their own judgment as well, because there is no responsibility of the company to explain everything, right? There should be some effort from the user as well, right? Let me raise this. Okay, so basically the framework part is done right now, right? Now the elements of financial statements. So asset, liabilities, equity, income, expenses. This we have already discussed when we started the day one, if you remember, right? So I don't think there is any need to discuss this. What are assets, what are income? I already explained to you in very much detail what are the definition of each and every one of this, right? Now these are difference between asset, non-current asset. Again, no need at all to look at this as well, because there is a separate chapter which I've discussed with you already. The assets, the non-current assets and the current assets, both of them I have discussed in very much detail. Okay, right? Now components of a set of financial statements. This I'm also not looking over here, because the reason is I'm skipping things because we've already done this, right? Financial position, profit or loss, we've already covered in the last lectures, right? Okay. Profit or loss we've already covered, right? In chapter 16, 17. The formats we've already looked at them. Changes in equity we've also covered this, right? So no need to look at this, because this is, if we look at this right now, if I'm teaching this topic at the start of the syllabus, it would be very wrong to teach this, because these things come at the end, right? First we have to go through double entry, the basic concepts, the T accounts. These are the things that comes at the end. Okay, right. So these are the last forms that we have to study, and hopefully after this, our chapter will finish, right? So let's look at these things, which are basically accounting concepts. These are also very important, right? And they are not discussed anywhere else in the book, right? First of all, there is materiality. Okay, this thing we looked above as well in the above topics. So an item is recorded as material if its omission or misstatement is likely to change the perception of understanding of the user of that information. Let's take an example. They may make inappropriate decisions based on the misstated information, right? Note that this is just a subjective assessment made by those who prepare the financial statements, right? And it requires them to consider the reliability of financial statements for decision making purpose by users, principally the shareholders, right? So let me make you understand. Basically, what is materiality? Any kind of information, if we don't write that, the user decision can change, right? Let's say if we had only one kind of good amount in our financial statements, those were sales. Every shareholder want to increase shares, or the sales of the companies, right? Every shareholder, every user of financial statements want that the company should have high profit, good sales, less costs, right? So that means, let's say if there was sales of 6.5 million and we forgot to write this amount. If we forgot to write this, this is a huge flaw in materiality, right? Because we did not basically represent this material amount. Material in English basically means very important, right? We forgot to record this important amount. So that means based on the sales, actually there will, these 6.5 million sales will be there in the business, but it's not represented in the financial accounts. So based on this, what will happen is that shareholder will say, okay, the sales are very less, I'm not investing. Okay, one more example is given over here. For example, consider if bank balance of a major company is misstated by $1 in the statement of financial position. This may not be recorded as a material misstatement, obviously, because this is a very small amount. So materiality basically means any important value or any important amount, we can say anything which is important, right? So $1 is not important. Let's say the normal bank balance of the company is $1 million. So if we record it just below by $1, it will not make any sense, right? The shareholders will say, okay, let it go. However, if a bank balance was misstated by $100,000, this is a big amount, right? This is more likely to be regarded as a material misstatement, as it is significantly distorts the information included in the financial statements. Okay, so this is the meaning of materiality. Now, after that, we have got one more substance over form, right? As noted earlier, if information is to be presented faithfully, the economic reality must be accounted for and not just the strict legal form, right? An example of this will be that you will encounter later in this text is the accounting treatment of redeemable preference shares. Although on legal form, so you remember redeemable preference shares, we've already covered this, right? So redeemable preference shares, if you remember, these were treated as a loan, right? So although legal form of these are shares, because these are known as redeemable preference, the word is their shares, right? Over here, there is an obligation to repay the preference shareholders, and so they are accounted for as a debt. So obviously it's redeemable preference shares. It looks like a share, but the word redeemable makes it redeemable. The word basically means that we have to give back the money, right? So redeemable word makes it basically we have to consider the actually the substance over here, right? Not the form. Form basically means the structure in which the word is designed, right? So from form we can understand this, these are shares, but from substance, if we look at it in deep form, it is basically called a liability. It is treated as a loan, right? So this is the meaning of substance over form. Let me give you one more example. Let's say I owned a debit card, right? Let's say this is a debit card, right? And let's say I did not use it because I had many other debit cards of banks as well. Like let's say I had two or three more as well. So this was just the fourth one. This was lying around. So I decided that I give this to my brother or sister. I give this to my sibling, right? Now, once when I decide this, everything on this card is of mine, right? The account is also linked to mine. The name is also mine. right? All the information, the credit card number, debit card number is also based on my bank account, right? So if we see the form of this, form basically means just to look at it just from a bird's eye view, right? Just to look at it merely, right? So if we look at it merely, this means that this is my card, right? But if we look at the substance, substance basically means who is actually using this, who is actually using to, benefit it. So that means my brother is using, not me. So that means brother over here, this is called substance over form. That card belongs to me, but my brother is using. So that's mean we have to consider substance over form over here. Okay, now going concern assumption, we've already looked at this before as well in some chapters, but let me repeat it. Going concern basically means the ability of the business to operate for the next 12 months. And this assumption can be of two things. This can be in some cases, they should be valid, and in some cases, it is not valid, right? So if it is valid, right, like if business predicts that it should be able to operate for the next 12 months, right, and for the foreseeable future, so if it is valid, the financial statements are presented normally, right? They contain both things, like non-current things as well and current things as well, right? But if it is non-valid, we have to basically do one change. We have to create the financial statements on a breakup basis, right? And on breakup basis means we have to exclude any kind of non-current things. We only include current asset and current liabilities. Everything is current, because obviously if it is not valid, this means that the company is not, confident in operating for the next 12 months. That means everything will become current over here. Okay, the further you can read from here if you want. Now, business entity concept, right? This principles means that if financial accounting information presented in financial statements relates only to the activities of the business and not to those of the owners, from an accounting perspective, the business is treated as being separate from its owner. So let me explain you this as well, along with the limited liability concept. Okay. Now, one second. So this is basically business entity concept. Business entity concept. Okay, so what's happening is that always remember that in a business there are owners as well, right? So owners will have two kind of earning, right? They will have the earning from the business, right? And they will have the earning. Let me write it over here. Let's write it like this. So owners in the business will have two kinds of earning. First, they'll be having earning from business activities, right? The business that they're sitting in. And secondly, they will be having some other sources as well, right? Like rent received, dividend received, if they have invested in some other company, right? So basically, business entity concept means that there is a big wall in between them. We cannot cross this wall, right? This thing cannot go over there, right? And this thing cannot come over here. These cannot cross the wall. These need to be separate in every case. Okay, right? So this is simply the meaning of business entity concept. In short, what happens is that it says that owners cannot combine their business earning with the other sources of their income, right? So let's say if from this business they were earning 100,000 per month, let's say, and from other sources they were having, like, let's say 300,000, right? So they cannot say that in total I'm earning 400,000. They will have to break it down, that business is separate, other sources are separate, because other sources can never be combined to the business over here. This is the meaning of business entity concept. Okay, right? Now, accruals concept we've also studied. Accruals concept basically states, this is the definition of this from here. These are recorded when revenues are earned, right? So that means transactions are recorded when revenues are earned and when expenses are incurred. This pays no regard to the timing of cash payment or received. So accrual concept we've already studied. This basically is working. This basically revolves around the assumption, right? Assumption. So that means even if we have not physically received cash, but we have earned it in any sense, so we have to record it in the financial statements. This is the meaning of accrual basis. You can study the example as well. If business enters into a contractual agreement arrangement to sell goods to another entity, the sale is recorded when the contractual duty has been satisfied, right? That is likely to be when the goods have been supplied and accepted by the customer. The payment may not be received for another month. So that means we have sold the goods, right? If you remember in IFRS 15, we studied the same thing, right? Like revenue is recorded when the performance obligations are satisfied, not when the actual cash is received, right? So revenue standard is also based on this accrual concept. So payment may not be received for another month, but in accounting term, the sale has taken place, right? So we can successfully record the sale if we are following the accrual basis in accounting. Okay, fair presentation we've already looked above, right? That everything needs to be reported as per the IFRS and IAS, as per the accounting standards. Nothing should be nothing should be blurry over here. Everything should be cleared, right? So this is the meaning of fair representation. And finally we have consistency. Again, consistency we also discussed above, that this means that the user should be able to compare the performance of the company. We studied this just above in the comparability thing, right? In the enhancing financial statements characteristics, right? So consistency means if one company is following an accounting standard for 1 year, it should follow for every year till that till that item that it's accounting for, it's not sold out, right? So this basically means consistency. And finally the chapter is finished over here, right? It was a bit theoretical one. It may be boring for some students, but again it has very interesting information, and this is also very important for exam purpose, because this will be asked to you certainly in section A, not in section B, but in section A. Okay, so now we will be moving towards the chapter 2, because in chapter 2 there is just one or two things that we have to discuss, just 10 or 15 minutes, right? We'll discuss that, and then we'll have a look at the exam kit questions. Okay, now we are beginning and starting the chapter 2. Okay, now this chapter 2 basically just has 2 or 3 things that we have to discuss. It won't take much time. Most of the things were in chapter 1. The most long things were in chapter 1, but these are very short things. So as you can see, this is chapter 2. This is called regulatory framework. Okay, now, basically, what is regulatory framework? Let's see first, right? So regulatory framework for the preparation of financial statements is necessary for a number of reasons: to ensure that the needs of the users of financial statements are met with at least a basic minimum of information, right? So again, the frameworks, everything, the regulatory environment, everything is basically there to just have, a kind of a benchmark, right? So that, the financial statements user might have something to understand from the financial statements. Okay, to ensure that all the information provided in the relevant economic arena is both comparable and consistent. Given the growth in multinational companies, the global investment this arena is increasing, the international one, to increase users confidence in the financial reporting process, because users will have confidence only when they know that company is following some kind of a regulatory framework. It's being controlled, it's being watched, right? And lastly, to regulate the behavior of companies and directors towards their investors. So this is also very important in regulatory framework. Now, national regulatory frameworks for financial reporting. So there are, 4 kind of, don't look at this everything in detail. We just have to understand it, and just, just for the sake of this chapter, because I don't think this topic is much asked in the exam. Okay. So national financial reporting standard, because in every country, nationally they're followed as well. Then national law is followed as well, market regulations and security exchange rules. So all of these basically influence the regulatory framework, right? This example, you can read it yourself. It's not important over here. Okay. Now we've got the main thing over here, which is topic 3. It is called IFRS standards. Okay. Due to increasingly global nature of investment and business operation, there has been a move towards the internationalization of financial reporting. This harmonization was considered necessary to provide consistent and comparable information to an increasingly global audience, right? That means there was a need, because this accounting standard was, being implemented internationally. That means there was a need for IFRS standards to be introduced, right? If companies use different methods of accounting, then before any decisions can be made about different entities, the accounts would have to be rewritten so that accounting concepts and principles are applied the same, right? So again, there is a issue that comparability cannot be done, because comparability will only be done in that way when consistently all companies adopt a similar kind of accounting standard. So in the old medieval world, this was not the case. This came in under, I think, the year will be written over here. Slowly the country started to adopt this. Okay, IFRS standards are not enforceable in any country. As we will see shortly, they are developed by international organization that has no international authority, right? So to become enforceable, they must be adopted by a country's national financial reporting standard setter. So it's upon the countries and the companies to adopt it. It's not important because there are not just IFRS and IAS in the world. There are other kind of accounting standards as well. Let's say that I think I've heard this, that China and Singapore, all the Far East countries have their own accounting standards. Then USA has their own accounting standards. Those are because USA does not adopt IFRS and IAS. I think those standards are called GAAP, right? GAAP standards. So every country has different ones. And again, these are not enforceable. These are all the countries written that who adopted these, who did not. Okay. Now, this is the main structure. This was the main thing that I was talking about in chapter 2, right? So what happens is that on the top there is the IFRS Foundation, right? Below that comes IASB. IASB is basically International Accounting Standard Board. It's written, everything is written over here, right? So you don't need to write anything in notes. After that, we've got IFRS IC. IFRS IC means IFRS Interpretation Committee. And according, these two come under the board, right? So AC basically means Advisory Council. IC means the Interpretation Committee, right? So basically, Interpretation Committee, interpretation means to explain something. If someone is not getting anything, to explain something, right? So IFRS IC does the same, that whenever there is confusion among the people, among the users, they come in and explain the interpretation. They explain what is actually happening, like what this actual accounting standard is about. Okay. Now let's read first about IFRS Foundation. So Foundation is the supervisory body for the International Accounting Standard Board. So this looks at the board, right? And it is responsible for the governance issues, ensuring each member body is properly funded. So this is main principle for the main objective for the IFRS Foundation. Okay, so principal objectives of these are: develop a set of high quality, understandable and enforceable and globally accepted standards, right? To promote the use of rigorous application. So if you're making the standards, you should also make people aware that follow this, it's very good for the company. After that, to take account of the financial reporting needs of emerging economies and small and medium sized entities. So if there is any kind of shortfall or loopholes, these should be identified and filled in, so that these everything is done by IFRS Foundation. Bring about the convergence of national and international financial reporting standards, right? This is also the work of Foundation. Now, the second one is International Accounting Standards Board, the IASB. Okay, so board is independent standard setting body of the foundation. Its members are responsible for the development and publication of IFRS standards and interpretations developed by the Interpretation Committee, right? So both the things, the AC as well, the Advisory Council and the Interpretation Committee, both of these come under the board. So board is overseeing them basically. Okay, all of the most important national standard setters are represented on the board, and their views are taken into account so that consensus can be reached. All national standard setters can issue a discussion papers and exposure drafts issued. So basically just vague things are being talked about, nothing special over here. Now the two main things who come under the board are IFRIC, right? So the Interpretation Committee, and IFRS AC, which is Advisory Council, right? So Interpretation Committee, what it does is it reviews widespread accounting issues, right, on a timely basis and provides authoritative guidance. So this is the main word, this is the keyword on these issues. So again, interpretation means anything being explained out, right? Their meetings are open to public and anyone can basically attend them, right, depending on where they are based. Now, what does the Advisory Council do? The council is the formal advisory body to the board and the foundation. It is comprised of wide range of members who are affected by board's work, okay, advising the board on agenda decision and priorities in their work, right, informing the board of the views of council with regard to major standard setting projects. So they just advise the board because they come under the ISB, right, International Accounting Standard Board. So they are just advising them what to do, what not to do. Okay, and lastly, giving other advice to the board or the trustees. So just for giving advice, just for giving guidance, this IFRS Advisory Council is there. Okay, now let's read this as well, like how an IFRS standard is made, because this is also very important, right? So procedure is as follows. Let's see. First of all, the board identifies a subject and appoints an advisory committee to advise on the issues, right? So first of all, it happens in everything. Like first we have to find a topic, right? Even if we are talking with a friend, We need to talk with a new person. We need to make new friend. We need to talk with the already existing friend. We need to first find a topic, right? So the same thing is happening over here. They first find a subject, that what is any kind of thing that is not covered by us. Is there any kind of accounting standard not covered by us? They first find and then they give the topic, right? After that, the board publishes an exposure draft for public comment. So this is just like a draft, like just like a rough thing on which the public can give their point of view. Do they think this is right or this is wrong? Any suggestions they want to give, right? This is the draft version of it, right? After that, following the consideration of comments received in the first draft, the board publishes the final text of the standard. So this is basically, like something like a crowdfunding thing. Like people are helping as well, not just the board. People are also, the public is also involved in this. They are also, giving their input in this, their point of view. At any stage, the board may issue a discussion paper to encourage comment, right? If the board thinks that there is more need of, explaining this, or more need of comments or the point of views of people, so they issue a discussion paper in this case, in which the people discuss. The publication of an IFRS standard exposure draft or IFRSC interpretation requires the votes of at least 8 of the 15 board members. So, again, there should be a majority vote so that that accounting standard can be finally launched in the world. Okay, so this is the whole procedure. I hope you got it. This thing I've already explained right over here in the separate entity concept, business entity, but let me give you a brief introduction again. So what happens is that there is a big wall in between these two people. I'm just making a big wall. Sorry, it's just made a little bit unsymmetrical. So this is the wall, right? Now these are the shareholders, these are the directors. So I just told you that shareholders are the ones who give the financing, who basically invest in the company. So these are the owners, because if there is no finance, there is no business, right? Now these shareholders appoint these directors to work in the company. These directors should be, proficient in doing their work. They should not be just normal people. They should be actually directors who should have proper experience, because they get a decent, you can say, remuneration package as well. They want to show their work. So directors are basically controlling the business, right? Like they have the control over the business. They are making the daily decisions and everything. Now directors have basically, uh, if you're thinking about this concept, that whose responsibility is this to make the financial account, so the answer for that will be directors. Directors responsibility is in every case to basically make the financial statements and to appoint auditors and the accountants as well, right? So directors work on objective, right? And they also have their own objective. These objectives of shareholders and directors, there is a big wall in between them. They cannot be combined. You can see it's written over here, not is equal to, right? So shareholders and directors objectives can never be equal. Okay, because directors don't work for shareholders. Basically directors are working for the public, right? And shareholders are not basically working for directors. Shareholders are investing for basically gaining the public investees, because the more the investment in the company is, the more better it is, right? So this is the difference. This is basically called company ownership and control. Control is with someone else, ownership is with someone else. Okay, this is a huge explanation of this as well. So in the free time, if you're willing to do this, you can read as well, right? Because I've already explained you with a lot of examples. I don't think there's any need for further explaining this, right? Now this is, I think, the last thing over here, right? This is called corporate governance. Let's do as well this as well. Again, we don't have to, understand. I understand these topics can be a bit boring for the students, but again, we don't have to look at anything in very much detail. Okay, so what is corporate governance? First, let's look at this, right? So the system by which companies are directed and controlled, this is called corporate governance, right? It's same as a regulatory environment. Every company needs to have a regulatory environment, right? So the system on which the company is being owned and governed is called corporate governance, right? So the use of term stakeholder suggests that companies have a much broader responsibility to the economy and society as large. This includes concepts such as public duty and corporate social responsibility. So all of these things are part of corporate governance. Okay. Now coming back to the point, what is purpose and objective of this? So the basic purpose of this is to monitor those parties within a company who control the resources and assets of the owners. Right. So this is the main purpose of this, to basically, have an oversight of those people within the company who are controlling the resources, so that those resources are being used in a correct manner. Okay. The primary objective of a sound corporate governance is to contribute to improved corporate performance and accountability in creating long-term shareholder value. Okay, these you can also read yourself. What are the purpose and the objective? Nothing special over here. The need for corporate governance. Why do we need this basically? Simply put, if the stock market mechanism is to succeed, then there needs to be a system that ensures publicly owned companies are run in the interest of the shareholders and that provides adequate accountability of the people managing those companies. Right. So these are all the elements that are involved in the corporate governance: effective management, effective systems of internal control, oversight, fair appraisal, fair remuneration, fair financial reporting. Everything is fair over here, right? Everything should be good and fair. Nothing should be on the bad side over here. Okay, so in order to be accountable to the stakeholders of the business, the directors of the company are responsible for preparing various documents and reports. One of the most important reports is the financial statements. So this thing I've already told you above, that financial statements making responsibility is with the directors, not with the shareholders, right? These provide a summary of the financial performance and position of the business. This information is crucial for the shareholders, in particular, who need to be able to assess the success of business during the financial period. Okay. Directors of the company are responsible for ensuring that company has an effective system in place for adequately identifying, recording, and summarizing all the transactions and events that take place during the year. They must ensure that controls that exist within that system are sufficient both prevent and detect fraud and error within the system. So all of the internal control systems, the financial statement preparation, disaster management, everything is the responsibility of directors over here. This is what it's trying to explain over here. These you can read. Even if you don't read, there is no problem, because this is just the boring kind of things like the act and all of these, the US Sarbanes-Oxley Act. So you can read this just for your personal knowledge, right? But I don't think it's important at this level. In FC level, I've never seen such question in the exam. Okay, got it. So this was the whole chapter. Chapter has been finished. Chapter 1 and 2 both are done, right? And mostly they're like regulatory framework, corporate governance, IFRS, how IFRS are produced. So these were the basic, um, what can we say, the basic theoretical knowledge that were involved in this topic. Now let's move on to the questions of these, right? We'll do a small set of questions because this does not have any kind of more questions. So we'll be doing the question 24 to 30, right? And the start ones you can practice it and let me know if there is any issue. Okay, so 24 till 30. Let's see. Okay, over here. Okay, now identify whether each of the following characteristics is a fundamental one or an enhancing one. You remember fundamental had 2, enhancing one had 4, right? Of useful financial information according to Iasb conceptual framework. Okay. Now comparability, we studied this. This is not a fundamental one. This is the enhancing one. We just studied it in the chapter a while ago, right? Timeliness, this is also an enhancing one, right? Faithful representation, this was a fundamental one, if you remember, right? There were 2 fundamental ones, relevance and faithful representation. All the other ones were enhancing one, right? Understandability, this is also an enhancing one. Okay, so very simple to do. Which of the following statements is correct? Let's see. Going concern concept guarantees that business will continue in operational existence for at least 12 months after the reporting date. Yes, so it is correct to some extent, right? But not 100% sure. Let's see option B as well. Let's see option B. Okay, let's look at option B. To comply with the law, the legal form of a transaction must always be reflected in the financial statement. So this is basically talking about substance over form, right? So always the form is not looked towards. And sometimes what happens is that substance is also looked. That I just give you the example of that card, right? We'll come back to this in just a minute. If a non-current asset is initially recorded at cost, is revalued, the surplus must be credited in the cash flows. No, in the cash flow it's not entered because I told you it's an unrealized concept, right? So cash is not realized till we don't sell the asset. So cash flow does not contain anything which is non-cash. So option C is certainly wrong. Now, option D, in times of rising prices, the use of historical cost accounting tends to understate assets and overstate profits, right? So, in times of rising prices, yeah, this can be somewhat correct, right? Now, let's look at option B and D together. To comply with the law, the legal form of transaction must always be reflected in the financial statement, right? So I don't think this is correct. Option D, option B should not be correct. Option D is correct over here, I think, because in option B, what happens is we have to consider the substance, right? Not always the form. Let's look at question number 26. So according to the Iasb conceptual framework for financial reporting, are the following characteristics that enhance the usefulness of financial information correct or not? Okay, we have to tell these. Okay. Now, relevance, comparability, faithful representation, and verifiability, right? So in conceptual framework, you remember that basically it's talking about the usefulness, right? So information will be useful, I think, if it is relevant, right? I don't think comparability is right or not, right? Faithful representation, this should also be there, and verifiability, right? So I think relevance should be the main thing that should be over here. Let's check the answer of this as well, just to be confirmed. So question 26, just a second. Okay, so it's basically comparability and verifiability. So it's asking about the usefulness over here. Okay, so for question 26, it's the second and the fourth option which is correct. One second. Okay, so comparability is correct and verifiability is correct. The other ones are wrong over here. Okay, now 27. Which of the following statements best explains the principle of faithful representation in relation to the preparation of annual financial statements? Okay, transactions are presented anyway it is considered appropriate, right? So I don't think this is correct because it's saying that in any way we can report them, but they should not be correct. Transactions are presented in such a way as to maximize profit for the year. No, this will be a subjective thing, right? This will involve like conflict of interest, because we talked about one thing, that even if sales are low, even if there is a huge loss, we should be comfortable with reporting that. That is basically the meaning of faithful representation. Okay, transactions are presented in such a way to maximize asset values in the statement of financial position, right? So this is also not right, I think, right? Transactions are presented to reflect their commercial substance of transaction rather than their legal form. Yeah, so this one is correct. This is same as question 25 that we studied, substance over legal form. The debit card example that I gave you, same will be applied over here. So option D will be correct. Okay, so let's do till question 30 and then we'll wind up the lecture. Which accounting concept requires non-current assets to be valued at cost less accumulated depreciation rather than their enforced sellable value, right? So I think the correct answer of this will be going concern, option D. Why not A, B, and C? Because A is prudence. Prudence basically says that this is basically, you can say, affiliated with the incomes and the expenses. Relevance is also not right because this does not involve any kind of relevance, right? And comparability is also not right because we don't compare assets in any way, right? So I think going concern would be right, because going concern requires that the term depreciation is an annual word, right? That means it's charged annually one time in once a year, right? So that means going concern is the only thing which involves going 12 months further and basically telling the company's assumption is valid or not for operating for the next 12 months. 29. Which of the following pairs of items are two fundamental qualitative characteristics of useful financial information, right? So this was basically useful. If you remember, in usefulness, we saw two things, right? And relevance and prudence, I don't think this will be right. Relevance and faithful representation, these were basically the fundamental one, if you remember, right? So that means these are the correct. We just had to tell the fundamental one. The other ones were the enhancing ones, and enhancing ones were the four items.